Some policies are simply inappropriate to the job that they're supposed to do. Some of them were placed inappropriately, i.e. they were sold without regard to what it was that you were exactly wanting to do. Maybe you had an agent that was not thorough in what they were asking about. Or policies can become inappropriate over time because of lack of adjustments that are made through exploration done in an annual review. So placed inappropriately, what do I mean by that? Well, when a term plan is put in place, term is a temporary policy, and it is put in place to do the job that is normally done by a permanent policy, that term plan is inappropriate to the task. For example, when somebody says, this $1 million term plan is the legacy that I want to leave to my family, they're going to get this $1 million. That is probably not going to work out the way that you want it to, and here's why. Term plans are designed to be temporary, and the companies are very good at making sure that they're temporary through a number of different ways. But the main one that I want to make sure that you're aware of is that when a term plan issues, the company that's issuing the policy is almost positive that under normal circumstances, you're either going to outlive the term or you're going to lapse or drop the policy before a death benefit is even required to be paid. Okay, so if you're 20 and you're buying a 20-year term and the company will issue it really cheaply, really fast, it's because the odds of you dying before your 40th birthday are almost nothing. They're almost nil. In fact, if you go, it's going to be probably because of accident or something that's completely out of left field. So it's a very big profit center. Now, if you die during that time, are they going to pay the claim? Absolutely. They won't try to get out of paying the claim. They've got the money. But you have to understand the tool is temporary, and it's being applied to a task that should be done with a permanent plan. Another one's final expense. 5-year renewable term. A lot of it out there with a company whose name you'd know. People are buying it. I talk to them. Why did you buy this? For final expenses. I don't want to be a burden. Great reason. 5-year renewable term, however, goes up every 5 years, and the one that's in my mind expires completely at age 80. So it's either going to go away at age 80 if you live beyond that life expectancy, because that's about what life expectancy is for everyone, or you can convert, but you're going to be converting later in life, and it's going to be really expensive than had you bought the appropriate policy in the first place. That's another example. And then finally, a permanent plan. I see young families all the time that will buy like $25,000 permanent policies and say, this is to protect my family. And I'm like, protect them from what? You've got a burial plan. If you've got young kids, that is almost always more appropriate to put a term plan in place with lots and lots of death benefit for the buck. The permanent plans can always be applied later, but that would be, in my opinion, an inappropriate use of permanent insurance. Folks, a lot of this comes down, it's a very gray area, and it comes down to just explaining what these things do and making sure it matches what you want and need for them to do. I hope that makes sense to somebody. Click on to the last video and let's wrap this up.